DIY bookkeeping looks like a way to save money, but for most business owners, it ends up costing a lot more than they think. I am Larry Davis, founder of Tax Help. We help business owners to clean up their book, reduce their tax bills, and finally get control of their finances. You know how it goes, and when you're running a business, every dollar counts. So a lot of owners think, why pay someone else to do the books? I can handle it myself. And at first, it really does seem simple. You've got one bank account, a few transactions here and there, maybe a spreadsheet or a free software. You swipe, record, and move on with your day. But then things start to pile up. You use the same account for both business and personal expenses, just to keep it easy. You're not sure where certain expenses belong, so you just guess and promise to fix it later. Receipts are scattered, invoices are somewhere in the email, and tax deadlines are closer than you realize. This isn't about being careless. It happens to smart, hard-working business owners every single day. Bookkeeping isn't just data entry. It's the financial foundation of your business. And if that foundation is shaky, everything gets riskier. Your taxes, your cash flow, even your growth plans. In this video, I'm going to walk you through 10 costly mistakes owners make when they DIY their books, and how avoiding them can save you real money, real time, and a whole lot of stress. Mistake number 1, mixing business and personal transactions. Here's the problem. The moment you mix personal and business expenses, your financial records get blurry. Imagine this. You buy lunch for yourself and your friend on the same card you used to pay for your office supplies. Later, when you're doing the books, you can't remember if that charge was personal or business. Multiply that by 50 little transactions over the year, and suddenly your books are a mess. Not only does this make it hard to track real business expenses, but it can also cause you to lose legitimate tax deductions. Why? Because the IRS wants proof that every business expense is actually for the business. And if they see a mix of personal charges, that raises a red flag. Here's the smarter move. Keep a dedicated bank account and credit card for the business. Every swipe has a purpose, and every expense has a paper trail. That's how you protect your deductions and keep your books clean. So if you're still using one account for everything, it's time to separate it before it costs you real money. Mistake number 2, misclassifying expenses or not categorizing them at all. This happens more often than people realize. You're busy running the business, so when it's time to record expenses, you just guess which category they belong to, or worse, leave them uncategorized to deal with later. For example, you pay for a new laptop, but instead of classifying it as equipment, you toss it under office supplies. Or maybe you pay for a business trip and accidentally code it as a personal expense, or you don't categorize it at all. It just sits there as a mystery charge in your books. You could end up paying taxes on income you never actually earned. Why? Because the IRS looks at your financial statements. If your expenses aren't recorded correctly, your taxable income could appear higher than it really is. The fix: categorize expenses correctly the first time. Use consistent categories that make sense for your business. And if you're unsure, ask a bookkeeper or tax pro. Mistake number 3, missing out on tax deductions and credits. One of the biggest hidden costs of DIY bookkeeping is missing out on deductions and credits. Most business owners don't even realize what they could have written off until it's too late. For example, a home office deduction, gone. Mileage for business trips, untracked. Industry-specific deductions like healthcare costs or equipment write-offs, completely overlooked. When these aren't documented properly throughout the year, they disappear at tax time, and the IRS isn't going to remind you. They'll just happily collect the extra tax. The smart move: track and categorize deductions as they happen and know what's specific to your industry. Every missed deduction is money you're leaving on the table. Mistake number 4, not reconciling bank and credit card accounts monthly. Not reconciling your accounts every month. When you don't match your books with your bank and credit card statements, you're basically relying on luck instead of accuracy. A small duplicate charge here, a missing payment there, or a bank fee you never noticed. These tiny errors pile up quietly, and by the time tax season comes, your numbers don't match, your reports are unreliable, and fixing it becomes a stressful, expensive cleanup. The fix: reconcile your accounts every single month. Catch small discrepancies early so they don't turn into big financial headaches later. Mistake number 5, mismanaging payroll and contractor payments. When you mismanage payroll or contractor payments, things can snowball fast. A late payroll tax deposit, a missing or incorrect 1099, A W-2 with the wrong numbers. These might seem small, but each one can trigger IRS penalties and state fines that stack up quickly, sometimes into the thousands. And once the IRS flags a payroll issue, they don't let it slide. The fix: stay on top of payroll deadlines, issue accurate forms, and keep clean records for every employee and contractor. Getting payroll right isn't optional, it's protection. Mistake number 6, recording revenue incorrectly. A common DIY bookkeeping mistake is recording every deposit as income, even when it's not. For example, you transfer personal funds into your business account, or you receive a loan to help with cash flow, but instead of recording it correctly, you categorize it as revenue. That might seem harmless, but it inflates your taxable income and makes your business look more profitable than it actually is. At tax time, that means paying taxes on money that isn't even income. The fix: always identify what each deposit actually is, revenue, loan, or owner contribution, and record it accurately. Clean records arm accurate taxes. Mistake number 7, ignoring accounts receivable and payables. A lot of owners record income the moment they issue an invoice, even if the cash hasn't hit the bank yet, or they log expenses they haven't actually paid. On paper, it looks like the business is doing great, but in reality, the cash flow tells a different story. This creates a false sense of financial health and leads to bad decisions, like overspending or missing upcoming bills. The fix: track what's actually collected and what's owed. Know your real cash position so you can make smart, confident business moves. Mistake number 8, no backup or documentation trail. One of the most underestimated mistakes in DIY bookkeeping is not keeping proper documentation. Receipts fade, files get lost. And that pile of paper on your desk, it's not a system. Here's the reality: if the IRS ever asks for proof and you can't produce it, they can deny every single deduction tied to that expense, even if it was 100% legitimate. Maybe it's that lunch with a client where you forgot to keep the receipt, or a subscription you paid for but never documented, or worse, years of paper records sitting in boxes, completely unorganized. When that happens, it's not about whether you actually spent the money, it's about what you can prove. The fix: go digital. Store receipts and invoices in the cloud. Keep everything backed up and make documentation part of your process, not an afterthought. Good records don't just protect your deductions, they protect your business. Mistake number 9, using the wrong chart of accounts. A sneaky but serious mistake in DIY bookkeeping is using the wrong chart of accounts. Most owners just use the preloaded categories in their software, like in QuickBooks, and assume it's good enough. But those categories aren't tailored to your business, and that's where the trouble starts. Maybe income from different services all gets lumped into one account. Maybe key expense categories are missing or mislabeled, or certain costs get buried under vague labels like miscellaneous. The result: wrong setup, wrong reports, or wrong tax return. Your financial reports end up giving you a distorted picture of how your business is actually performing. And when your CPA prepares your taxes, those inaccuracies can lead to missed deductions, misfiled returns, or red flags for the IRS. The fix: build a chart of accounts that matches your business model. A clean, customized setup gives you clarity, accuracy, and control over your numbers. Mistake number 10, waiting until tax season to catch up. One of the biggest traps business owners fall into is waiting until tax season to catch up on their books. You know the drill. Months go by, receipts pile up, transactions aren't categorized, and you tell yourself, I'll handle it when it's time to file. But by the time April rolls around, it's not bookkeeping anymore. It's financial damage control. Errors are buried deep. Deductions you could have claimed are long gone. And your CPA, they're forced to file as is, even if the numbers aren't clean. This doesn't just cost you deductions, it also creates massive stress, last-minute scrambling, and a higher risk of IRS issues. The fix: stay consistent year-round. Keep your books updated monthly or quarterly. Clean books mean fewer surprises, more deductions, and a much smoother tax season. Doing your own books might feel like saving money, but hidden costs add up fast: missed deductions, IRS penalties, and extra stress. Clean, accurate books aren't an expense, they're protection. If you're a business owner struggling with back taxes or IRS debt, hit subscribe right now. Every week, I share real strategies to help you reduce what you owe legally. And also, like this video and we'll send you our 10 tax strategies for businesses to reduce their tax bill.